Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for Saturday, January 7th, 2023. It's great having you with me here today, and really wanted to focus on news that we got during the market hours yesterday. Yeah, the employment number was an important number. We covered that yesterday in our Daily Economic Market Shout. Today, we're going to talk about the ISM Services reading. It moved to contraction. It was the lowest reading we have seen since early 2022. What happened? Yeah, we saw new orders drop significantly. In addition, we saw orders canceled. What does that mean? Companies are concerned. They're concerned about their inventory levels, and because of that, they're seeing their customers be worried about their inventory levels. And when they look at customer inventories, what they're seeing is they're about where they should be. And what does that mean? That means there's not a lot of tailwind for additional orders moving forward. If customer inventories were low, we would expect customers to continue to try to build that inventory, even though demand may wane a little bit as we move through 2023 as expectations for a US recession are growing. So we saw the slowdown, not too surprising. Market reacted, believing that inflation may move down with it, and therefore the Federal Reserve can take a break in its tightening cycle. However, one reading underneath that did not show prices improving, meaning fall. They showed prices being raised, continuing to be at a very active level. Why is that? Why are businesses raising prices at the same time their demand or their orders are falling? One element of that is pricing power. They're believing, and this has been shown throughout the pandemic, that they have a unique niche, some differentiation in their product mix that makes their product not susceptible to industry or economic elements. So they can continue to pass along higher costs that they're seeing and not be too worried about it. We will see how far this lasts and how long it lasts, but it does tell us that service inflation is there. It persists even if demand has fallen. And so we want to be recognizing that we are in a kind of a changing environment through 2010s. In so far, even this decade, we've seen an advancement in technological innovation. It's been the fastest growing part of investment, which is part of the GDP equation. What does it mean? It means that these innovations have spurred growth, which is great, and how that growth is used can distort what we had normally thought about the economy and how businesses operate, even on the micro level. If you don't have differentiation, you then are a price taker, you are susceptible to the growth and competitiveness of the industry. If you are not a price taker and you can differentiate, you can step beyond that. Businesses seem here to be making that statement, and we look at staples sector in the S&P 500 in 2022, we see it as one of the best categories, roughly flat. S&P was down more than 15%. So that differentiation is occurring in areas that we're a little surprised at seeing it, because traditionally staples were the cost plus business, very low margin, just grinded it out, try to make innovation to sort of keep in line with their costs. The world has changed. And I think a lot of it is what we're learning about the customer and that element of what differentiates someone. So businesses can look to reduce costs, but also can keep price as they know that they have a premium value that customers are concerned with. So going forward, this may not be the sign that service inflation is easing. This may persist longer than we expect, and therefore the actions by the U.S. Federal Reserve may be quite different than expectations. Clearly, more to come on this. This is Scott Murray for the Daily Economic Market Shout. Thank you for joining me.